Hey guys, welcome back to the Millionaire Mindset. If you find this video informative, please be sure to drop a like and also consider subscribing. With further ado, let's get into the video. The Securities and Exchange Commission's (SEC) surprise lawsuit against fintech startup Ripple Labs has become a cause célèbre in the cryptocurrency community, but its broad implications about regulatory overreach against innovation are sparking principled debates in some of the country's most influential policy circles. Last week, experts from the Federalist Society's Regulatory Transparency Program (RTP), an organization dedicated to fostering discussion and understanding of regulation, spoke at an event titled SECV, Ripple Labs, Cryptocurrency and Regulation by Enforcement. The SEC sued Ripple and two of its top executives in December for 7 years of cryptocurrency XRP distributions that the agency labeled as illegal unregistered securities trades. Ripple provides a global payments platform for the XRP token and its fully decentralized ledger to approximately 2 million users worldwide. The company vehemently denies the allegations, stating that the regulatory agency allowed billions of XRP tokens to circulate freely on global cryptocurrency exchanges for 7 years without making such a determination, despite years of being asked in public and private for that specific clarity. The SEC also claims that XRP's only utility is an investment contract in Ripple, and that all XRP holders rely on Ripple's actions to earn a return on their investments. The suit seeks an injunction to prevent XRP from being registered as a security and to bar Ripple executives from participating in the market. The discussion focused on whether and to what extent the SEC may violate the legal and constitutional principles of fair notice, due process, and the rule of law. The sudden thud dropped on the last day of the previous SEC chairman's term, after XRP had been in circulation for so long, was seen as suspicious by many. Committee for Justice President Kurt Levy, a well-known conservative attorney and scientist, moderated the event. The following is a synopsis of the panelists' points of view. People use XRP as a form of currency. Because of the SEC's action, the value of XRP has plummeted, 50 exchanges have delisted or suspended trading in XRP, and the currency has lost 75% of its value. XRP holders are outraged, having been forced to sell in a panic following the SEC's action. Separately from Ripple, John Deaton of the Deaton law firm and the website Crypto Law is leading a challenge to the case. He filed a writ of mandamus in to challenge the SEC's egregious, inappropriate action, and then a motion to intervene in the SEC's case in the Southern District of New York on behalf of over 18,000 XRP holders. Many of these people, app developers, organizations, businesses, and others swear they had never heard of Ripple before the case and had never seen XRP as an investment contract in any company. Prior to the SEC's action, XRP could be found on over 200 currency exchanges. The SEC is now on trial in the Ripple case, and they know it. We need a Ripple test to stop the SEC's cryptocurrency overreach. SMIC is one of several semiconductor fabs with military ties in China. Many countries are creating digital currencies, and some of them may use the XRP ledger. According to the World Economic Forum, XRP is the most relevant cryptocurrency for central banks. Financial regulators in Japan, Singapore, the United Kingdom, Switzerland, and the United Arab Emirates have already declared that XRP is a currency, not a security. Wallets, marketplaces, money transfers, banks, and more than 150 consumer apps are among the 360 organizations that use the currency as a means of exchange, according to xrparcade.com. Some companies use XRP to pay international employees, and consumers use it to buy groceries and subscribe to Time magazine digitally. Deaton outlined a series of actions, events, and conflicts that he claimed weakened the SEC's case. Ripple and the Department of Justice agreed in 2015 that XRP is a convertible digital currency, and that Ripple is an XRP transmitter registered with the Department of Treasury's Financial Crimes Enforcement Network, FinCEN. Ripple agreed to follow U.S. currency laws rather than securities laws. When the SEC filed cases against initial coin offerings in 2017, Ripple was not among them. The SEC approved Ripple's $30 million equity investment in MoneyGram in 2019 to expand money transfer via blockchain. Similarly, Ripple informed the SEC of their intention to list XRP on Coinbase, a cryptocurrency exchange platform. The SEC made no statement in response to these events, implying that XRP is not a currency and that Ripple is not in compliance. Former SEC Chair Joseph Grundfest pleaded with the agency not to pursue the case, claiming that it would result in multi-billion-dollar losses to innocent third parties. Deaton also detailed a number of troubling, unseemly conflicts of interest with previous SEC leaders who favored other tokens with far more solid investment contract arguments while hammering Ripple. The SEC has a bad sense of style. Carol Goforth of the University of Arkansas School of Law commented on whether a transaction qualifies as an investment contract, defined as investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. For the purposes of the SEC, such a determination classifies the asset as a security, making it subject to disclosure and registration requirements under the Securities Act of 1933 and the Securities Exchange Act of 1934. The term comes from the Supreme Court case SEC v. W.J. Howie Co., in which the defendant was a man with citrus groves in Florida who kept a portion for himself while selling real estate contracts to finance future growth. Goforth argued that the SEC was correct in its decision, but that the SEC acted inappropriately and at an inopportune time against Ripple. Goforth observes that the value of XRP is derived, at least in part, from Ripple's efforts. She is, however, outraged by the SEC's treatment, noting that it took years to issue the ruling. A similar fate could befall Bitcoin and Ethereum, both of which are in danger of being redefined by regulators. The problem for Bitcoin is that there is no single party against whom the SEC could file a lawsuit. Or perhaps because the SEC would have to sue China, which has long controlled the Bitcoin hash rate. She also noted that XRP has many applications that the SEC's action has not necessarily preclude. People continue to use it as a form of exchange. Furthermore, the DOJ FinCEN settlement does not exonerate Ripple from additional charges. It is worth noting that the case has not been rescinded by the new SEC chair, Gary Gensler. His preference, however, is for Congress to clarify how the SEC should proceed. This admission supports the view that Gensler's predecessor, Jay Clayton, acted arbitrarily. Goforth concludes that the regulations are a mixed bag that disproportionately affects Ripple. There should be room for reasonable exceptions, which will almost certainly necessitate a congressional act to address. How regulation fosters a privileged investor class. In his best-selling book George Washington, Entrepreneur, How Our Founding Fathers' Private Business Pursuits Changed America and the World, John Burleigh, senior fellow at the Competitive Enterprise Institute, traced the history of financial innovation, noting how the first president used tobacco warehouse receipts for money. Burleigh disputed the notion that cryptocurrencies endanger investors, instead pointing out that misguided regulation increasingly excludes middle-class investors from financial markets, limiting their ability to reap their benefits. He used Home Depot as an example, which went public in 1981 at $12 per share with only 4 stores. Entrepreneurs' ability to raise capital through markets and exchanges is becoming increasingly limited. SEC regulation has had the unintended consequence of increasing costs and legal and regulatory requirements to the point where firms must become significantly larger before going public. Small investors are less likely to participate in larger IPOs with higher threshold requirements. Cryptocurrency has emerged as an alternative to centralized finance and allows small investors to participate, but government intervention is impeding the democratization of innovation. Burleigh pointed out numerous flaws in the SEC's arguments, as well as the consequences for other parties. He mentions the Howey test's lack of a working definition and limiting principle, which has led the court to rule, for example, in United Housing Foundation, Inc. v. Foreman that shares in private cooperative apartments were not securities. Even in the Howey case, the court noted that the shares on offer were for the Orange Grove real estate, not the oranges themselves. This appears to be an important point in relation to Ripple and XRP, as investors have purchased currency rather than stock in the company. The Howey test stated that a security is a product whose value is determined solely by the efforts of others, but the SEC and lower courts have broadened that to any efforts by the product maker to increase the value of the product. Many companies that produce products that can be purchased as investments, such as comic books and baseball cards, make efforts to improve product placement and promotion, which increases the value of their products, but this does not qualify their products as securities. Dollars are interesting in that they would be exempt because the securities laws have a specific exemption for currencies. However, as Ripple points out in its response to the SEC Wells notice, the plain language of this exemption would also apply to cryptocurrencies. See page 4 of Ripple's response. The SEC essentially keeps the exemption only for state-backed currencies.